course, this conversation happening in a very challenging environment. Of course, South Africa's economic situation, like that of several countries globally, is under stress, such as increased expenditure and general money woes. South Africa's GDP growth is below the average seen in emerging markets. Its current account and trade deficits are the highest globally. And joining us to chat about the economic situation in South Africa and the world at large is George Herman. He's the head of South African investments over at Citadel. Thanks so much, George, for joining us this afternoon. Of course, you hear the kind of conversations happening, and it's happening in a context that you've titled Double, Double, Toil and Trouble, Fire, Burn and Cauldron Bubble. This sounds very, very ominous.
No, Alicia, not at all. It's not ominous. In fact, it's great news. Last night, specifically, the JSE for the last year is up 20.4% for the year. For the last 10 years, it is up 20.4% per year for the last 10 years. That is somewhat worrying, considering that that is exactly 4 times our inflation rate over that exact same period. But South Africa is not alone in that regard. Even in the developed world, we see the exact same phenomenon, how financial assets are outperforming inflation tremendously, and hence that title.
While that gets you excited, let's take a look at what this means, though, and whether there is a sustainability behind this drive that we're seeing on the equity side of things. If you're looking at it relative to the fundamentals of the economies within which these markets operate.
There are quite a few fundamental worries, which you are spot on correct on. But right now, the theme in the world has been that central banks are supporting markets, are supporting systems, banking systems, financial systems, putting money into that. And for now, equity markets are just feeding on all of that cash, and hence this can still be sustainable. Unfortunately, if you analyze the numbers, the fundamentals of economic growth and of company earnings and profitability is slowing down and is not justifying those type of returns. But in the face of cash, that'll still happen. So
when it comes to investment strategy, then, how do you play within this space?
This is a tricky one, because right now everybody is getting excited about equities. Equities have performed spectacularly, and right now, on a relative valuation basis, equities are by far the best asset class to be in. All fixed income investments seem expensive on a historic basis and relative to other instruments. Equities still have some earnings, and there are some sectors that are dramatically undervalued, which could be seen as value. So there's a lot of opportunities in the equity space. So by far, equity is the preferred asset class. But with that track record of enormous returns up to now, one has to be careful. What we need to do there is to diversify. Although everybody's clamoring towards equities, you must make sure that you diversify by strategy, by geographic region, by manager. So just make sure that you keep on diversifying.
Let's bring it to the South African context, specifically looking at valuations on the JSE, because overall, if you're looking at the index, it's a market that's not looking that expensive, but there are vast discrepancies between the subsectors of the JSE.
Yes, 100%. The first one is that between our financials and industrials against resources, it is an enormous discrepancy. But that discrepancy is not only in South Africa, that's been a global phenomenon. So right now, you must see the world where they see GDP growth, and they're quite scared of GDP growth slowing down, and hence mining and resources stocks are absolutely being knocked down. Either one of the two must be wrong. Either the forecast on GDP growth that we have bottomed, that GDP improves from here, or that resources stocks start performing, but one of the two has to happen, otherwise one of the two are wrong. The resources and mining sectors across the globe are too negative compared to where expectations for GDP is. So yes, in terms of valuations, that's the first discrepancy. And the second one is that South Africa doesn't seem expensive versus its own history. 16, 17 is not that dramatic, but compared to our peer group, we stand out as being expensive against our emerging market peer group.
What do you see that doing to investment flow into South Africa, where emerging markets as a whole is sitting on the radar screen?
Well, the flows into emerging markets have been enormous, and it's been one of the dramatic themes. And over the last 2.5 years, money has just flown in week after week. Until last week, first money flowed out of the emerging markets for the first time in literally 2.5 years. But that's just one little blip. Fact of the matter is, what's unique in South Africa is that we've had enormous flows into our bond market because we were included into the World Global Bond Index. So a lot of flows in there, record inflows into our bond market, and very little into the equity market. Come 2013, and suddenly we see some strong inflows into our equity market. So quite clearly, that's some good news. So I think some global investors are recognizing some of our undervalued sectors.
Where those inflows into the bond market have been supportive of the local unit in the past, you would have expected the additional now inflows into the equity space acting as additional support for the local unit, and yet we've got the rand moving in the opposite direction, weakness coming through in a big way. We've had it hitting that 9.11 mark, and many saying that we could well be targeting 9.25 moving forward. How concerned are you about the rand right now?
Alicia, I'm not concerned about specific technical levels. I'm just sketching the background here that we've seen record inflows into the bond market. Despite that, the rand weakens. In a background where we have some of the biggest current account deficits and budget deficits in the world, on a low GDP growth environment, that just sets up the perfect environment for a currency to depreciate over time. I see the OECD is now advising the SARB that they should intervene, and thank heavens the SARB is not doing that, which is fantastic. But the ground is set up right now for a depreciation in the currency, so I am kind of concerned about that. Obviously, with the strong flows, we saw 10 billion rand flowing into our market just last month, both equities and bonds. There's still an opportunity for the rand to pull back, to go back to 850. So those technical levels don't concern me, but the setup overall, quite clearly for a weakening of the currency.